Hello and very warm welcome, esteemed viewers. My name is Gopika Nair, and I'm thrilled to have you with me today for what I consider a connoisseur episode. So, for anyone serious about understanding the corporate finance. We are not just going to talk about the theory, so we are going to inhabit a real world finance model. So we will be conducting a forensic line by line examination of a complete three statement financial model analysis of a company which I took, which is Aurobindo Pharma Limited Company. So this model is a tapestry woven with numbers, each thread representing a business decision, a market condition, a strategic assumption. So on like over the next 26 to 30 minutes, we will be become fluent in its language. So we will unravel the story of the Aurobindo Pharma Limited Company and also its past performance and its ambitious future trajectory as told through this scroll and this Excel sheet. So this is more like a review. It is an immersion. So we will explore the cover sheet, the company overview, the presentation sheet, profit and loss calculated, balance sheet, cash flow statement, geographic revenue model, segment revenue model, cost model. So these are the model which we are going to do step by step. So, we will cumulate our journey by interpreting the valuations output to answer the ultimate questions. So, what is the enterprise truly worth? So, I encourage you to settle in for this a deep, detailed, and I believe profoundly enlightening exploration into this engine room of a pharmaceutical giant. So let's talk about the architecture, the model context, and the foundation context. So before we can run, we must learn to walk. And in financial modeling, that begins with understanding the source and the structure of our data. So let's first open the cover sheet and the direction sheet. Let me show. Okay, this is cover sheet. Let's go with the company overview first. Okay. So let's talk about the directions. Now the direction sheet is a usual user manual. So it provides why we have taken the company or a bond. It is one of the leading pharmaceutical company of a country, creating a great demand for such a model in the investment market. This immediately frames the company significance. It describes Aurobindo's evaluation from an API supplier to a focus on generic formulations. So, highlighting its vertical integration, its global footprints across the US, Europe, and emerging markets. So, this narrative is a bedrock upon which all numerical assumptions are built. The model isn't created in a vacuum, it's a quantitative reflection of the every business story. So let's talk about this company overview. As you can see here, they have given a per share data and key ratios. Here a geographic revenue breakup for 2009. Here product revenue breakup for 2009. Then we can see here revenue forecast, enterprises value added, and these are the data which I will be explaining one by one. So now let's lay the cornerstone with the company's overview. So this is our central hub of for key inputs and summary outputs. So under this company overview, we should codify the business. The industry is pharmaceutical. The sector is pharma. Country is in India. So these are the critical for comparative analysis and bench and peer benchmarking. So here, let's highlight everything. So here we find out our first major input, the current market price. As you can see here, current market price is 753. Okay. And this is the anchor of our entire valuation exercise. From this and the number of shares, the model calculates a market capitalization of approximately 48,656 million or about $650 million at the time. So this is the market current price tag for the entire company's equity. Okay, now as you can see here, they have given geographic revenue breakup for 2009. So this model actually provides a brilliant snapshot of the company revenue streams. So for this fiscal year 2009, we see a total consolidated of 31,242.43 million. So sorry for the disruptions, guys. Sorry for it. Let's continue. And let's dissect the so as I was telling, the consolidated geographic revenue breakup for 2009 is 31,242.43 million. Okay. And let's dissect this geographically. The lion's share, it's a staggering rupees 24,444 million. Okay. And which comes from India. And the rest of the world contributes rupees 6,432 million, where while China is smaller, which is around 366, which can round off of 367 million. So this tells a company's story with a dominant home base and a growing international presence. So as I can see, which is a darkish blue, India 78%, lighter shade of blue, China, as you can say, a 1%, and rest, which 21%, as you can see, it is the rest of the world. So these are the geographic revenue breakup for 2009. So now even more revealing, let's go to product revenue breakup for 2009. So this business is split between formulation, which is like mostly finished drugs at rupees 14,098 million, and an active pharmaceutical ingredients at rupees 16,466. So these are the active ingredients, you can see here 16,466, and the total here is $14,988 million. So as you notice that in 2009, APIs were the largest segment. However, the narrative in the directions, hence the formulations are likely to replace the going forward. So this is a crucial forecast, and this we'll watch for the next projection. So the API segment itself is broken down and into SSPs, SEVs, ARVs, and others, which is showing us a diversified product portfolio within the bulk drugs business. This level of detail, which allows for a nuisance and accurate forecast. So let me tell you, you see USA, formulation of USA is 5,584, Europe 1,923, ARV 4,640, and the rest of the world is 1,951. And all of this total is 14,098. Then for even here, as you can see, active ingredients also. Now let's go to the income statement. Okay. So while with the foundation set, let us ignite the engine. The true pulse of any company is captured into the income statement, and the presentation sheet offers a magnificent granular view quarter, year by year. As you can see, this is the presentation sheet. So observe the trajectory of a total income. Data. Sorry, wait. Total income, it climbs from rupees 21,229 million in the first year 2007. Wait a second, guys. Just a minute. First year to 21,000. Okay, just a second. A little confusion here. I'll be just a minute. Okay. And to rupees 31,000 for, but here it's confusion. Wait a second. Yeah. Okay. Yeah, got it, got it. I'm explaining about this revenue forecast. Okay. Listen properly. And but the model ambition is revealed in its forecast, a projection to more than double reaching to like 88,331 million by first year 2014. So this is not random. It is a mathematical expression of the growth story we read earlier. And now let's click over to the geographic revenue model sheet to to see the growth expected on the achieved. So this model forecasts India will remain the powerhouse, growing from rupees 24,444 million to over rupees something 70,890 million. 890 million. So, but also note that the rest of the world is rupees 16,837 million. So, the model is assuming successful execution of both domestic as well as international growth strategies. Okay. So, now I'll return to the presentation sheet. Now, you can see the revenue is variety, the profit is sanity. Did the growth come at the cost? Let's examine the profitability. So we start with the operating income. We start with the operating income. The profit from cooperation after all the operating expenses, but before interest and tax. So it was rupees 4,510 million in first year 2009, and then the model projection nearly tripled to 12,601 million by first year 2014. So this is a growth signal of scalable growth. Now look at the EBITDA, which means earning before interest, tax, depreciation, and amortizations. So this is a critical measure of operating cash generating ability, stripping out of non-cash charges and capital structure. So in first year 2009, EBITDA, which stood at rupees 5,891 million, and the forecast seen it soaring to rupees 14,737 million by first year 2014. So crucially, let's examine the EBITDA margin. The margin was a healthy 19.3%. Okay, but in first year 2009, but in the forecast, it stabilized between 16.1 to 17.1%. Why this tight compression? This is a realistic assumption. As a company grows, especially into competitive international markets, it can face pricing pressures, leading to a slight margin contractions, even on much higher absolute profit. So this is a sign of sophisticated, not overly optimistic model. Now let's scroll down to the net profit and diluted EPS. Wait a second. So here now we arrive at the bottom line, the profit after tax. Okay. So what ultimately belongs to the shareholder? This is where the story get incredibly compelling in the first year 2009. Was something 999 million, but the model forecast explosive growth trajectory projected PAT to hit 9,632 million by the first year 2014. So that is a nearly a 10-foot increase. The net profit margin tells us the story perfectly, jumping from a merger 3.2% in first year 2009 to robust 10.9% by first year 2014. So this implies a model in baking in massive operational efficiencies, then economies of scales, and potentially a more favorable product mix, shifting towards higher margin fluctuations or formulations, I would say. So the stellar profit growth directly fuels the most watched metric on the Wall Street and Deloitte Street. EPS, the diluted EPS was rupees, I can see a diluted EPS was rupees 15.43 in the first year 2009. And the model forecast it to the capture to 165.55. As you can see, the diluted here 165.55. So that is for first year 2014. So this growth is the primary rocket fuel for the company's valuation as well as we shall soon see. So now let's go to the fortress of solvencies balance sheet. Okay. As I know, everyone know about how the balance sheet works. So I will be explaining the balance sheet of this Aurobindo Pharmacy Limited. So here a company can be a profit machine on paper, but if it is financial structure, it's unsound. It can collapse like a house of cards. The balance sheet is a fortress, the must with an economic storm. Let's open the balance sheet and to access Aurobindo's fortifications. So I have opened this balance sheet. The balance sheet is a snapshot of the company's financial position at the period's end. It must always balance what it owns. The assets must be equal to its owns, meaning liabilities, plus what the owners have invested, that is equity. So first liabilities and equities. Okay, under loan funds, we see total debt, which was 18,470. Where is loan? You see loan funds where we see the total debts. That is 18,470 million. Okay. Um, in first year 2009, 470, as you can see here, this amount. But this is a significant amount, which, however, observe the forecast, it is projected to be deliberately reduced from rupees 15,570 million by the first year 2014. See, here 15,000, or yeah, and here 18,000. 2009, 2000, there is a difference though. So it reduces the interest expense, financial risk, making the company more resilient. So to fund this debt repayment and fuel growth, the model projects a surge in shareholders' equity from rupees 12,000. Yes, you can see, wait. I'll move down also if you want. So I was talking here that the equity was shareholders' equity, which was from rupees 12,239 million to rupees 47,709 million. So this growth does not come from issuing the new shares, but from retained earnings. So the accumulated profit not paid out of as dividends. So this is the purest form of organic growth financing. So let's scroll down the applications of funds. So now where is the money being deployed? So assets. So it is we are deployed. So this is the application of funds, and I'm talking about the fixed assets and liabilities. So here where our money where it is deployed, of course in assets. So the net block of fixed assets grow from rupees 14,074 million to rupees 25,841 million. So this is a tangible evidence of a capex. We will see in the cash flow statement investment in factories, machinery, and land to support the massive revenue growth. So let's under current assets, we see inventories. You can see here, we see the inventories, we see sundry debtors, then growing in line with revenue where it is logical. More sales require more inventory, typically lead to more account receivables. So the cash and bank balance are volatile, ending at a projected rupees 2,886 million in the first year 2014, which is a comfortable position. So let's go to the balance sheet metrics. As you can see, this is the balance sheet metrics. The raw numbers are the informative, but ratios transform them into insights. So let's diagnose the company's health. As you can see, the current ratio here, it is a short-term liquidity. A ratio about 2 is consolidated, healthy. Here it is fluctuate, remains between 2.8 and 3.4, and the company can easily meet its short-term obligations. Now, day sales outstanding logged at 95. As you can see, it is all, as you can see, from 2009 to 2014, it is all logged from 95 days in the forecast, and it is a very critical assumption. And it means the model assumes it takes a company on average just over 3 months to collect the payment from its customers. This is a long cycle, but common in pharma where trade channels are involved. So let's talk about the inventory days. So inventory days holds for about 3.4 months. This reflects the manufacturing lead times and shelf life of pharmaceutical products. So as you can see, book value per share. Here, this is the net asset value per share. It is projected to grow magnificently from 180 rupees to 280, 820. So this signifies tremendous value creation for the shareholders. As the underlying asset base supporting each share um, is becoming very substantial and more valuable. So now let's go to the cash flow statement. So as you can see, this is the cash flow statement. So now the income statement can be accepted. The balance sheet is a snapshot. So what is the cash flow statement? So it is an unvarnished truth. So it tracks the real movement of the cash, the lifeblood of the business. So let's examine the cash flow statement. Now, the statement, as you can see, there are three acts. One is cash flow from operating activities, from investing activities, from financing activities, and more on there. So, but there are morely three activities. Okay, let's talk about the cash from operating activities. Um, this is the most critical. It starts with the net profit and adds back non-cash charges like depreciation. Then it accounts for the changes in working capital, the real cash impact of growing receivables and inventories. The bottom line here is a net cash from operating active. In first year 2009, it was a positive rupees 1061 million, and the model forecast this to grow into a powerful positive rupees 6648 million by the first year 2014. So this is the hallmark of a truly healthy business. It is generating a copious amount of cash from its core operations. Now let's talk about the investing operating cash flow from investing activities. There is almost always a negative number. So, and that's not a bad thing. So it represents the company's investing in its future. Here we see consistent expenditure ranging from rupees 2292 million to over 5316. So this company is reinvesting its cash back into the business to build capacity for future growth. So this is a sign of ambition and a long-term vision. Let's talk about the cash flow from financing activities. This shows the company's transaction with its financiers. And we see a periods of debt, repayments, and notably a significant foreign currency convertible bonds in the first year 2012. So which is a major cash outflow, and this aligns perfectly with the delivering story we saw on the balance sheet. So the grand finale is the net increase in cash. So while it jumps around year to year due to its financing and investing cash flow, it is very much sustainable. And the model, despite a company that fund its own growth, manages debt responsibly, and maintain a solid cash positions. Now let's go for the final valuation. Now we have now assembled the entire puzzle. We have the growth narrative from the income statement, the financial strength from the balance sheet, and the cash relativity from the cash flow. This is the final cumulative step. So to synthesize all of the singles compelling questions. So, what is the intrinsic value of Aurobindo Pharmacy Limited? So, let's return the presentation sheet. So, here the model provided several industry standard lenses for valuation. Let's focus on the forecast for first year 2011 estimated. Okay, now the year price to earning ratio. Here, as you can see, price to earning ratio. Wait a second, press. Yeah, price to earning ratio. So this is a 9.54. So this is a very compelling number. And it means the market is valuing the company at just 9.5 times its forecasted earnings. So given the explosive EPS growth, we saw PE, which is profit to earning, is low, often suggests the market it's undervaluing the company's future potential. So it's like finding a high growth stock at a value ratio. Now, price to book means it is 2.0. The stock trade at twice its book value. So that tells us about the market which recognizes and it is very significant value beyond the company's physical assets, its brand, its intellectual property, its human capital, its growth prospects. Now let's talk about EBITDA, which is 7.08. It enterprises value includes both equity and debt, making it a holistic measure. Now, it also below 8 to 10, it is often considered attractive for growing company and again hinting at a potential undervaluation. Now, let's go to switch to the company overview. And finally, we have the crown gel of valuation. We have the discounting cash flow. This is a forward-looking intrinsic value valuation method. It does not rely on market comparables. Instead, it takes the free cash flow we inferred from the statement rupees 7,583 million in the first stage and discount them back to the present value, accounting for the time value of money and risk. So the model accumulates in a total enterprise value of rupees 62,384 million. So what is the grand conclusion I we would give? So the model through every single assumptions, projection, calculations builds a coherent and a compelling case. It portrays Aurobindo Pharmacy, a company on the cusp of a transformation growth phase driven by a strategic shift to formulation, robust revenue expansion, soaring profitability, strong cash generation, and responsible financial structure. So the valuation metrics, particularly the low PE ratio, price to earning ratio, and the DCF derived value, they are initially suggest that assume market price of rupees 75, rupees 753. The company stock represents a potentially attractive investment opportunity as the market may not be fully appreciating the sheer scale of the growth and efficiency journey that lies ahead. So we reach the end of our journey from a single line on a cover sheet to a complex DCF valuation. We have followed the numbers whenever they led us. And we have seen how the financial model is not a crystal ball, but a logical framework, a story written in the language of finance. I hope this is a deep dive has demystified the world of financial modeling and empowered to you look at a company's financials with a more critical and apprehensive eye. So, if you have any questions, any thoughts, at all, the comment section below is a perfect place to continue the conversation. If you found this masterclass valuable, if it is provided to you with a even a single moment, please support this channel by liking this video, subscribing for more content, and hitting the notification bell so you don't miss any future explanation. Thank you so much for watching this video. Bye.